Hi everyone, we made it. We're about to finish 2022. One more month left to go. Only December left in what's been a brutal year for stock market investors. All kinds of stocks are down, all kinds of asset valuations are down, and at least one thing that has been a silver lining for investors is that there's been a lot of buying opportunities here in 2022 as a lot of stocks are down significantly off their highs. Okay, with that said, I'm going to highlight the best stocks to buy with $500 in December. The Walt Disney Company. The Walt Disney Company. The stock has been hammered here in 2022, not as much as other companies have been. It's held up relatively well, but still it's down. It's giving investors a good opportunity to buy at lower prices. And one of the benefits from investing in Disney is that the theme park segment has been absolutely crushing it here in 2022. Revenue and profitability have exceeded 2019 levels despite international visitation yet to recover. Now, remember, international visitation, as I've said in other videos, accounts for about 20% of Disney's overall revenue and profitability in the theme park segment. So even without that part of it recovering, the company is still doing better than 2019 levels. And that's great news for investors as we're still grappling with the effects of COVID-19. International travel restrictions are still in place, and so it's not easy for folks to travel between countries. And despite that fact, revenue profit levels are exceeding as this unleashes, as folks get more freedom in where they can travel, in how they can travel with COVID restrictions being removed. This will make it a lot easier for Disney to recover the international visitation revenue. Moving along, the streaming segment is adding millions of subscribers, and the Disney Plus in particular is going to implement price increases coming soon and launching an ad supported version of Disney Plus that can add an incremental source of revenue and profits here in December and going forward in all of 2023 and further along. And then the box office is coming back to life. Avatar 2 is coming to theaters in December, with estimates suggesting near $3 billion in box office revenue for this movie. And that could be a huge boost to Disney's free cash flow generation, which could be great news for investors, and it will help Disney. One of the downsides of Disney stock has been the elevated debt the company has undertaken for, these last couple of years as the company has grappled with the impacts of COVID-19. Well, if it's able to generate 3 billion in box office revenue from this film, that could go a long way to helping pay down some debt and reducing that interest cost and bringing its equity to debt levels in better ratio, in better proportion. Finally, the company's trading at a forward price to earnings ratio of 23, which is the lowest it has traded for in the last year, going back to October 21. So I would say it's relatively fairly valued, especially considering that the company should recover in 2023. Its earnings per share should recover in 2023 for a couple of reasons. Number one, management has noted that the losses in the streaming segment have likely peaked and they'll start coming downward in 2023. And also the fact that the theme park segment is thriving and should continue to thrive in 2023 as consumers unleash pent up demand as international visitation recovers. So the company's trading at a relatively fair value. All right. The second stock I would say to buy if you've got $500 to invest in December is Alphabet. And of course, Alphabet is home to Google, which is the most dominant search engine in the world, and it's home to YouTube, which boasts over 2 billion monthly active users. This is critical because when consumers look to when consumers are starting their buying journey, when they're thinking about buying something, most of the time that starts with either a Google search query or a YouTube search where people want to get a product review on YouTube. So either way, Alphabet benefits from that, and they get to show advertising to those folks that are looking to purchase something, right? Of course, marketers would like to get in front of potential customers that are beginning their journey, beginning the research process of buying something, especially if that something is high valued, like a car or maybe a travel um, uh, a planning for a trip for international travel or anything like that where consumers are spending thousands of dollars. Marketers would want to get in front of that and say, hey, come to us instead of going to our competitors. And so they're willing to pay Alphabet for the privilege to show advertising to these 2 billion monthly active users and all of the folks that use Google search. And of course, that there's evidence in that Alphabet generated $257 billion in revenue in 2021 and earned a 31% operating profit margin on those 250 billion in sales, which is incredibly good. And then besides its robust existing revenue and profit engines, Alphabet has a cloud business that's ramping up, that's growing robustly. And if you compare cloud, if you look at one of the most mature cloud businesses, which exists inside of Amazon, AWS, that segment for Amazon is generating north of 30%. Well, I shouldn't say north, just around 30% operating profit margins. And if Alphabet can ramp up its own cloud segment, which is approaching billions in revenue, that could be another source of healthy operating profit. It's not there yet. The segment is not delivering the Amazon type operating profit margins just yet, but the potential is there if you're looking at the other player in the space. And then finally, Alphabet is home to one of the leading driverless tech companies in Waymo, and driverless technology is being pushed by several companies who are desperately looking for that service in order to help their businesses reach profitability. One example is Uber. If Uber can implement driverless technology, who knows how high their profitability can reach. Right now, paying their drivers is the highest expense for a company like Uber and Lyft and DoorDash. If driverless technology becomes mainstream and they're able to implement and use it in high volumes, that could ramp up their profit margins. And so those are just a few examples of companies that will benefit tremendously from driverless technology. And then just like Disney, Alphabet is trading at a relatively bargain price. If we look at the price to earnings ratio here of 19.12, it's at the lowest it has traded for going all the way back to 2014. So the lowest valuation in nearly 8 years investors are able to get Alphabet for. So I would recommend these two stocks. If you've got $500 to invest in December, I would recommend buying Alphabet and Disney. Right now, they're each trading at less than $100 per share. So if you're looking to split up between the two, I would say you can get 3 shares of Alphabet and 2 shares of Disney. You'll have some dollars left over as well between your $500 allocation. But that's how I would split it up. 3 shares of Alphabet, 2 shares of Disney. That's how I would invest $500 in December. Alright, so if you've gained any value from this video, please go ahead and hit the like and subscribe button. I make a lot of videos like this one. If you're subscribed, you'll get the updates on my latest content. And thank you for watching. I'll see you next time. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.